You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.
Good morning, thank you. I'd like to bring out my panelists, Jessica Teitelbaum of ORC, Francine Fang of KCG, Sepna Patel of Morgan Stanley, and Liz Martin of Goldman Sachs. On behalf of WILD, I'd like to thank OIC for including us and inviting us to do a panel. As a member, I'm very pleased to be up here, and Jessica is president of WILD, and we will hear a bit more about WILD this morning. And would certainly encourage those women who are not members of WILD to look carefully at the organization, because I think that there are a lot of benefits that membership in WILD can offer to you. I'd like to get started by saying I'm really pleased to be joined by these four talented women today, and we're going to cover a host of issues impacting listed derivatives that impact both the industry as well as your customers. Today, there are a bevy of women in the listed derivatives space, working at broker-dealers, exchangers, vendors, regulators, but there's still a lot of work to be done. One of my panelists shared yesterday that while her male colleagues were invited to golf, she wasn't invited. I'm sure as many of you went back to your hotel rooms last night, you received an invitation to go visit with some pinup girls this evening, which I know is something that doesn't hold much interest for me, and probably not my panelist as well. But with that said, I do believe that women represent themselves quite strongly in the business, and believe that over time will continue to become more integrated and represented in the industry. At this time, I'd like to introduce my panelists. Jessica Teitelbaum wears many hats within the listed derivatives space. She's the co-founder and president of Women in Listed Derivatives, WILD, a nonprofit organization that helps women advance in listed and OTC derivatives. She is also a marketing director for the Americas at ORC Group, a member of the Futures Industry Association's FIA Chicago board, and a reporter covering the capital markets for the online publication, The Glass Hammer. Francine Fang is head of options market making business at KCG, the firm founded by the merger of Knight Capital Group and Gecko. Previously, Francine served as managing director of electronic market making and head of automated liquidity provision at JP Morgan. She also led the global electronic market making business at UBS. Francine holds a master's in English and a bachelor's of science degrees in electrical engineering and computer sciences from Massachusetts Institute of Technology. Sepna Patel is the head of market structure and liquidity strategy at Morgan Stanley for the Americas and is an executive director on the Morgan Stanley Electronic Trading Desk, MSET. In her current role, Sepna focuses on market structure issues, regulatory developments, order routing, liquidity strategies, as well as business development. Prior to joining MSET in 2008, Sepna spent 3 years on the institutional equities sales and trading coverage attorney in Morgan Stanley Legal and Compliance Division. She began her career at the SEC in the Division of Trading and Markets and held various positions during her 5 years at the agency. Liz Martin is the Chief of Staff for Global Equities and the Global Head of Equity Management at Goldman Sachs. Previously, Liz was an equity derivatives trader for 8 years. She joined Goldman in 2000 as analyst and was named managing director in 2009. Liz serves on the board of directors of the ISE and represents Goldman Sachs on SIFMA's listed options trading committee. Liz earned a BA in economics from the University of Pennsylvania and is a CFA charter holder. And with that, what I'd like to do is ask each of the panelists to describe a little bit about how they got into the derivatives business, what it means to be a woman, whether they felt any unique advantages, disadvantages, and just their overall perspective.
Hi, I got into the industry, it fell into my lap. I was a creative writing major in college, and I put my resume on Monster. Someone found me on Monster, and I started working at a technology consulting firm for the capital markets. And from there, I moved into a journalism role, and I took on financial journalism with John Lothian and Company, and then kind of moved into more derivatives from there. As a woman in the industry, I think that it's been an advantage because a lot of times, as the only woman in the room, I bring diversification. And I also have to say that I think there's experienced women and emerging women, and I really believe that the experienced women that came before me really paved the way for women of my generation, and it is, I think, easier for my generation of women because the women that went before fought to be where they are. And so we always appreciate the experienced women in Wild and definitely recognize their efforts and education and experience, and they're sharing their experience.
Oh, thanks. Thanks for having me on the panel. So I was thinking away very lucky to be hired into a convertible bonds trading desk when I first started. I really liked that product. And then eventually moved into electronic trading. I think the biggest difference is when I curse is in higher pitched voice. I think people kind of notice it more, want to help more. I also think I work well with a lot of quants and developers, which are probably a good thing given the electronic space. So I felt very fortunate that I felt comfortable with that. Bless you. I always felt very comfortable working with guys, and I think there are a lot of great friends. I have a lot of really great managers, so I feel very fortunate.
So I had a very odd introduction into the listed derivative space. Those of you who know me, I am a lawyer by trade, and I went to law school. And I know at the time when I was looking at potential opportunities after law school, I had every intention of going to work at a large corporate firm that was going to pay me well, and I was going to pay off all those student loans that I had acquired over the time. And I still remember my securities reg professor coming to me and saying during my second year, you might want to consider the SEC. And I remember the reaction that I had, why would I ever want to do that? Why would I want to consider the SEC? And he basically painted this picture for me that if I ended up leaving law school, I went into a firm, I would be doing a lot of grunt work and memos for the first 3 years of my career. But if I went to the SEC, where at the time it was the late 90s, early 2000, where there was such a high turnover rate, that I was going to be working on projects that were hot topics that I could open the Wall Street Journal and I would read about as a junior attorney. And I was going to basically interact with people in this industry that I wouldn't have the opportunity to interact with. And so I ended up at the SEC right out of law school. I ended up in the division of market regulation that was known back then, Trading and Markets Now, in the Office of Market Supervision, which specifically worked with the equity and the options exchanges. So my first exposure to the options world was rule filings with the options exchanges. And that same year was also the time frame where the CFTC and the SEC were working on rulemaking under the Commodities Futures Modernization Act. So including putting a framework around products like security futures. So that was my first exposure to the futures markets. But the one thing that I did find fascinating about my time in the listed derivative space at the SEC was I work with a lot of women. And so from the staff attorneys that I was working with, to the woman who was overseeing the options group, to even the woman who was heading the division at the time, it was a lot of women. And so I didn't have that same type of introduction that some of my colleagues here have initially when I was working in that space. So during my 5 years there, I went through a lot of changes with the options industry, from decimalization to automation to demutualization. And the last big project I worked on before I left the SEC was Regulation NMS. And everyone knows Regulation NMS has had both positive and negative impacts on our options as well as our equity markets. And part of what I heard from all of you all in the industry when I was in that role was, you're sitting there as a lawyer theoretically thinking about how these rules are going to play out in the marketplace, but you've never worked on Wall Street, you've never traded, you've never been a market maker, you've never worked from a practical standpoint in this industry, and we're telling you they're not going to work the way you think they are. And so it was one of the reasons I left. It's one of the reasons I ended up at Morgan Stanley, initially in a legal role. I worked closely with our derivatives desks, with our equity desks, with the regulators, with the operations folks, the technical folks, to really understand the weeds of it. But I still found in that role, I was working with a lot of women in the legal space, but everyone that I was working with on the options desk or the options market making group were all men. So it was the first kind of distinction that I was making. And then in my current role for the last 6 years on the electronic trading desk, I now have the opportunity to work with both the buy side in addition to the regulators, sell side firms, as well as the exchanges. And I find kind of the same thing. I'm seeing in the listed derivative space a lot of men kind of dominating the area, but I don't think I would have gotten the exposure or the involvement in the listed derivative space had I not started out the way I did, working with a lot of women from a legal and a regulatory standpoint.
Well, thanks to OIC and Jerome for putting this together. You know, I got my start in the industry probably similarly to a lot of people, where I did a summer internship in a listed derivatives business, passed out some resumes at Goldman Sachs, and the guy who ran the options desk at Goldman Sachs called the guy who ran the options desk at UBS and said he should hire me. So, you know, I got my start with, you know, people who kind of made a decision to invest in me through relationships in the industry, which was important. But I think kind of more important when I thought about, you know, just perspective on being a woman in the industry, there was sort of 2 things that I would, you know, love to leave you with. You know, when I think about my career, I'd say more than how did I get into the industry, it's why am I still in the industry? And I think the single most defining part of my experience about particularly being a woman in the listed derivatives industry is that I've had great mentors and sponsors throughout my career. And I bring it up in this forum because, you know, I think a lot of us have found that a lot of the great parts of our career have been driven by having great mentors and sponsors. And these aren't your managers, they're the people that take a step back every day and think about, you know, are you getting the experiences you need to grow? Where, like, who are the people you should be meeting? Are you connecting with the right kind of clients so that you can actually learn more and grow? And the one thing I'd say is if you think about your organization and you go back and you look at the talented women or the people that you think can be, you know, the future talented women in your organization, you know, I just ask the question, like, whose job is it in my organization to make sure that these women are getting that information? Because I think one of the things that happens a little bit differently is that's more of an organic, natural process in within, you know, a large group of men or a large group of women. You get that feedback every single day, like in every single thing you do. And I think one of the things that's really important if it's, you know, we want to grow more women in the industry is to make sure that, you know, you could actually point to a person in your organization who's managing a talented woman and say, like, you know, is he telling her that this meeting is more about relationship than, you know, content? Like that is, you know, was the feedback good or bad from the client? And so, you know, I've had that great people who have sort of done that with me and made sure that I was growing that way. And I think it's a really tangible thing that everybody can do and take away. The other thing that I think I'd bring up just from a perspective of, you know, a woman in the industry is, you know, I was struck by the exchange leaders panel where we talked so much about technology, and every single exchange leader sitting there talking about technology. And, you know, what it always makes me think is, you know, the pace of change in the financial services industry is so fast now. And it requires bringing, you know, to some degree, bringing in a different kind of skill set in some cases. You know, the problems that we're facing are much more technical, quantitative, and those types of things. And if you look at that skill set, you know, one of the things that we face a lot of is you're just competing with a different kind of talent pool now. You know, you're competing with Google and Facebook for your talent as opposed to, you know, because you need technical talent as opposed to just, you know, it used to be that everybody wanted to come work in financial services. And so if you think about your organization and you say, okay, on top of that, if I'm in this hyper competition for talent, trying to bring in the best people so we can have the best commercial people, if you're not actually attractive to half of the college graduates in the country as a starting point, that's a massive kind of commercial gap. in terms of being able to bring in the talent that we need in order to face the types of problems we face in the financial services industry right now. And so, making sure that within your organization you're kind of developing the female talent, and we spend a lot of time on it to make sure that those people are getting the opportunities to advance is, something that personally I'm pretty passionate about.
Thank you all. I'd like to switch gears a little and talk a bit about Wild. As I mentioned, Jessica is the president and founder, and I'm hoping, Jessica, that you can tell us a little bit about your organization, the membership, some of the benefits that it provides.
Absolutely. So Women in Listed Derivatives, Wild, I can't take credit for the name. That was Leslie Sutphin from Chopper Trading. She came up with the very clever name. But we started in 2009, and we have right now 1,200 women on our global distribution list, and we have about 400 paid members in North America and Europe. 10 countries are represented within those members. And just to give you some statistics about the breakdown of our membership, 50% of our members come from trading firms, 28% from exchanges, 11% from investment banks, 15% from technology providers. 75% have 10 or more years experience, and 20% have more than 30 years experience. So we really do have very experienced women in Wild. We have a 3-year, you have to be in derivatives for 3 years to get into Wild, to be a member. And that's just because we have such experienced women. We just want to protect them as well. Some of the roles that they have are 35% are in sales and marketing, 23% in operations, 9% in middle office, 7% back office, 14% in IT, 5% engineering, and 9% in HR. So just a breakdown of the members. Some of the things that we do, we have an annual symposium at the Federal Reserve Bank of Chicago, and we work with them. And we brought in Terry Savage. She's on the board of the CME group, and she spoke about getting onto boards. We've talked about, Liz brought up mentoring versus sponsoring, and a lot of people don't realize that mentors are coaches, but sponsors is someone that's going to like have your back and be like, hey, this person is very good for this role, and they have these skills for this role. So we talk a lot about mentoring versus sponsoring. We also do a negotiation workshop. It's our most popular member workshop, and that's because we found that women do not negotiate as much as men do, and so we try to just kind of help them strengthen their negotiation skills. So we do a member workshop like that. And then we also have a mentoring program, and where we couple up experienced women with emerging women, and it's a year-long program, and it's just, again, just to kind of share experiences and help out. And it started all because back in 2009, I had a group of like 10 friends, and we were all having the same thoughts, the same questions about the derivatives industry, and it would be great if we could just kind of ask questions to some of the women that had gone before us. And we kind of joined forces with Leslie Sutphin, who had a group of experienced women, and so it really is, Wild is really made up of experienced and emerging women. And we have branches in Chicago, New York, London, Singapore, and Frankfurt. We have members all over, but those are where our branches are right now. So,
Thank you, Jessica. Switching gears a little, we've certainly heard a lot about market structure. Exchange leaders talked quite a bit about it, and certainly equity market structure has been very prevalent in the news recently. Could you, each of you, talk a little bit about what impacts you and your customers on the options market structure side? And why don't we start with Liz?
Yeah, so I think similar to some of the sentiments we've been hearing kind of throughout the conference, our customers are pretty focused on making sure that the markets are safe and sound. It's a pretty big strategic priority within our own organization, and there's been a lot of great dialogue over the past 2 days about ensuring that we have mandatory controls and price checks and drill-through protections and activity-based protections for all market participants to make the markets more safe. I think the thing that we spend a lot of time focusing on is, we're really at a critical point in the industry with respect to this, because we've always said that the best advertisement for the industry and the health of the industry is the deepness and liquidity of the markets, like the quotes we see on the screen, and there's great pride that I'm sure all of us take in the room in making sure that that's protected. I think what's happening a bit with our customers now is they're actually questioning if that's enough, right? And it actually reminds me a lot of 2008 when you went through the financial crisis and you had a similar experience in the OTC market where clients were saying like, if I can't get out of my trade easily, I don't know if I want to get in it. And so while I think that we've all done a lot to kind of foster the building of those deep and liquid quotes that are a great advertisement for the transparency and liquidity of the market, it's really critical now. I think that there's so much attention within the client base of, we used to worry about getting out of OTC. Now should we be worried about getting out of listed if the market shuts down for a day or the quotes are going to gap or I get a report and then 5 hours later I get a non-report? Those are the types of things that they're really focused on. And so, we really applaud all the efforts amongst the people in the room that are focused on kind of bringing that together. But it's critical that we as an industry make change now and get the markets more safe, more sound and resilient now, because that's what you're starting to hear in the customer side is, should I be questioning it? And it reminds me a lot of the depths of the financial crisis.
I think I agree with Liz on a lot of what she said. It's a concern of ours. It's a concern of our clients. I think regardless of asset class, the one thing that we really don't need as an industry is for something to happen in the marketplace, for it to be front page news, and as a result, it erodes investor trust and investor confidence. We've seen it over the years. I think one of the biggest things that has always hit the front page of most papers is technology glitches. And technology glitches after flash crash have been on the radar. Now, you've heard others mention it this morning. We're in a very technologically driven, automated environment where everyone's interconnected. We all have technology issues on a regular basis. They're just not the grand technology issues that impact the marketplace to the extent that they get the notoriety. But when they do, that's when clients are impacted, that's when they are responding to their investors, and that's what we spend a lot of time on, having those conversations. And it's not just why did it happen, it's what processes do you have in place, or what do you put in place to make sure that it doesn't happen again, and it's how we address that. To give one example specific to the options industry, the Opera issue that we had last September, we spent a lot of time with clients on that one. And the reason I separate that one out is it happened a few weeks after the NASDAQ SIP issue. And those clients that trade both asset classes saw the nuanced differences of the two market structures that a lot of people don't have to account for in the day-to-day. And so the first question that I had gotten was, well, we saw that when we had the NASDAQ SIP issue, NASDAQ as the primary listing market shut down trading across all and 50-some venues in the equity space. Why didn't that happen in the options space? So why was this, why do we have different options exchanges all shutting down at different times? And so you're inevitably having that conversation with the client where you're saying, well, there's no concept of primary market in the options space, nor does it make sense in the options space. But regardless of whether or not you thought it was an inefficient process, we all have processes to handle outages at exchanges or excluding them from your routers. So it was manageable. I think the bigger issue with respect to that customers had a harder time with was there was a race to open when the issue was resolved, and there was a competition among the options exchanges to be there first. And the customers felt the brunt of that because for those venues that were not ready and executions took place, the customers were on the receiving side of those busts. And so I think one of the things, and I think that the exchanges are working on this, is having a more uniform process around the reopening of reopening of the options markets after an issue that solely impacts the options markets, but not necessarily the underlying securities. And that's an area, and we heard about competition in the previous panel. Competition is what drives our markets. But then there are areas of competition where competition is not necessarily a good thing, and you need uniformity. And this is one area where you actually need uniformity in terms of a more efficient way of getting markets up and running. in a manner that doesn't impact the customer. And then just related to that, the last bit of that was, and we touched upon this in the previous panel as well, the error rules. I think one lesson learned from Flash Crash in the equity space was the exchanges on the equity side had to have uniform error rules across the board. And it's very difficult to have a conversation with a customer when you're sending an order slice to one options exchange and another to another options exchange, and the execution gets upheld on one, and then it gets busted on the other. And they don't understand the nuances, and so you're sitting there trying to explain to them the nuances. So I'm not saying they need to be the exact same type of rule set as the equity space. There are legitimate arguments as to whether or not you should have obvious error rules and catastrophic error rules in the time frame necessary for more egregious errors. I'm just saying it would be very helpful from our client perspective as well as our perspective if those rules were uniform across the board. And then from a firm perspective, I think the processes also make it difficult. So you look at the sheer number of options exchanges that are out there, and it's 12. And if you have different notification processes, whether it's picking up the phone, filing a form, different time frames based on the customer base, it makes it more complicated in a very complex environment already to address that. And so that's kind of from an options perspective, those are some of the conversations we're having with our clients in terms of some of what they're seeing that's impacting them.
From, I guess, a market maker perspective, I mean, Andy, I think from Taproot did a great job. Is it possible to get the presentation from him? Because I would like to share that. And just technology glitches, things happen, and I echo both what you said. The issues, I mean, as a market maker, I think we have a tougher time. We don't get busted. We don't know if it's going to be, if it does, then we already hedged. What do we do? It's one of the things I am very appreciative of what SIFMA's been doing to try to help us coordinate that. I think will make the market a safer place and build more public trust. However, the thing I think I worry about the most is really about regulatory changes that are happening. I think it's going to cost everyone. Trading options is going to be more expensive for exchanges, would be for market makers, broker dealers, and customers. I miss my OCC discount rate. I understand. I very appreciate Mr. Donahue kind of explaining the rationale. It makes total sense. But it's in an environment that's happening. I will very much like OIC and the whole collective of people here. How do we make this more efficient? How can we make the cost more manageable? How can we educate each other and maybe the regulators go, what's actually causing harm? What's not causing harm? I think that's what I worry about the most because the margins are thin. There's a lot of, we gotta be sophisticated. It's a technology management issue. We have to continuously improve. I just want to collectively work together to make sure that we provide the best marketplace for trading options in a way that makes sense.
Switching gears and putting on my org hat, from a technology perspective, I don't have to say how important technology is, but there are a lot of options and options. And with the 12 venues, I think that we see a lot of our clients kind of chasing the liquidity a little bit. And I think that one of the challenges that we see them facing is identifying and then accessing the liquidity. And with the fragmentation and everything, I think that our clients they might not be a member of an exchange that has liquidity at that time, and like things change, and liquidity might not be where it is today, it might be different tomorrow. And I think that is one of the challenges that our clients face, is just identifying and accessing the liquidity. Another thing that we take into consideration at ORC, besides the exchanges, is just, I know that we spend some time wondering about investing resources in dark pools and ATSs, and wondering how those are going to impact our market. Everything is client-driven, but we do kind of take that into consideration too, and just how much we should invest resources there as well.
Terrific, thank you. One of the things that we've heard some talk about this morning is that there are now 12 options exchanges. And we've seen a number of new entrants over the past year. And as a result of that, it's created fragmentation into the options markets. Can you share the impact that this has had on your business and whether your clients have benefited from the proliferation of new exchanges and Sebna, would you like to start?
Sure. I know there was a lot of talk about fragmentation on the previous panel, in the equity space especially, and then how the options marketplace was different. I think when you look at fragmentation across both, we have, and I won't talk my own book, we have both fragmentation in the exchange space as well as in the broker-dealer dark pool space. I think that's just a fact. There was an evolution that we used to see where competition used to lead to fragmentation, used to lead to consolidation, or venues that couldn't exist ceasing. And then you'd see the circle kind of start again. We're not seeing that sort of consolidation. We're not necessarily seeing venues that go out of business. And there's a reason for that in our market structure. The options exchanges are kind of moving in the same direction that we saw with the equity exchanges, and the same thing's happening in other regions that have an order protection rule. If you have the infrastructure, you have the people, you have the rule set already, it's very easy in today's environment to start another exchange. With protected code status, it also requires all of us to then directly or indirectly connect to those venues because we don't have a choice under the current regulations. So we have to establish the connectivity, we have to pull in the market data, we have to go through the agreement process, we have to become members. But it helps an exchange that starts to basically grow. So you do see that type of fragmentation, and it was mentioned earlier that we may see more down the road. There's no incentive to stop that from continuing. And that's both options and equities, right? We're seeing the same thing, just to address the dark pool issue that was raised earlier when it comes to broker-dealer dark pools. For broker-dealers who operate dark pools as part of their overall offering, but it's ancillary to other services that they provide, they can continue operating one that does very little volume, but it's not an additional overhead cost. So you don't necessarily see those going away either. So there's fragmentation when it comes to venues. I wouldn't necessarily say there's fragmentation when it comes to liquidity though, because we're all interconnected in this ecosystem. But the one main distinction I will make is given the 12 options exchanges, the now 12 equities exchanges as of yesterday, and the ADF, those are all venues that all of our firms are required to access, whereas the 40-some dark pools that we have, you can make a judgment call as to whether or not, from a best tech standpoint, you want to access those venues.
Liz?
Yeah, I'd say fragmentation, it would be great if there was less, not more. That said, the exchanges all have business models and are for-profit companies that should be, doing what's best for their shareholders as well and have obligations there. I think the more important thing is, with a strong safety net of controls to reduce errors, the interconnectedness created by fragmentation is a little bit less problematic. And the only other thing I'd add is, innovation is great. And so to the thing that is probably a little bit more frustrated from having to connect to every venue from a dealer perspective as they proliferate is, kind of Me Too models are a little bit harder to justify the value for your end client than people that are actually bringing forward very innovative ideas to provide more liquidity to the marketplace, to clients. Those are things that I think, the value of the innovation outweighs in many cases the actual fragmentation. So I think, strong controls, lots of innovation, that's good. You can sort of manage the fragmentation to some degree.
I have to say, I think because we're relatively new, option market maker would benefit at having more exchanges, especially the new ones. So thank you for the new exchanges, giving us the opportunity to, for example, be a lead market maker. And also, I think, like my business partner, Dennis, has said before, choices are good. You service different business needs. And I think because there's more exchanges, more competition, I think there's a lot more innovation. And I definitely see really great technology coming out of the exchanges, really great innovative price improvement mechanisms. And I think I have to say benefited us. And thanks for the exchanges for giving us a chance.
I want to talk on the innovation point. I think that with 12 exchanges and tighter markets, it's really important to find liquidity and volume growth. And one of the things I think that weeklies and minis and birds and just different contracts coming to the market with flexibility and just innovation, I think is really important. And just on talking on, I was looking at different products that have come to the market in the past couple of years, and, one of the things I just found really interesting was that January 24th, 2014, weeklies doubled volume at Cboe. And I just think that new contracts like that are really important to the market. And I would, with the 12 exchanges, I think that a lot of, I would welcome innovation and new products and just trying different things. Because I think that that is the stuff that maybe it might be trial and error, but I think it's really important for the market and adds volume and liquidity.
Continuing along that theme, Francine, can you share with us what new product innovations, what new product launches have meant to you?
We definitely, the weekly is a really great example. Again, back to Andy's report, it's fantastic to see. I think the product, what I found is like the investors and retail investors particularly are getting more sophisticated. I think that's it's a really good job on OIC and the retail brokers for doing that. I think the idea is we have to grow the pie. So rather than fight each other for the same amount of pie, it's really nice to see the exchanges working so hard to work on those new products. That really helps. And I think the institutionals will come back. It's nice to hear about the pension fund potential. It's also very great to hear about European investors. Those are the things we want to do collectively. I think we should grow the pie together. I think we should help. And as a market maker, I'd love to help in products that will take off. So any way we can help would be great.
I think the innovation when it comes to products is actually so beneficial to our customers, and I think the exchanges do a good job of that. And I think the weeklies, since we're on the weeklies, especially the front two weeklies, are very attractive to our institutional customer base. Jessica was asking me, do they trade in large size? Yes, we have clients that actually trade in large size. It's a cheaper alternative for all intents and purposes. There's higher turnover, there's a lot less risk, and it's become a very attractive product to our institutional customer base. Just to take another innovative product, we have the minis as well, which was more kind of targeted to the retail customer base, given the 10-share underlier. Not seeing as much activity in those, and I know it's only on certain names where retail clients have that option, but it's less liquidity, wider spreads, and again, a great creative innovation, but not taking off as much as we would have expected.
The only thing I'd add, I think the other panelists have handled it well, is one of the great things about the weekly product is it really brought a different client base into the market, at least on the institutional side. It's popular. It's a product that's very popular with retail, but from the great thing about weeklies is it really drew in a sort of a macro institutional hedge fund community into the space. People that very traditionally would trade products like across equities and let's say interest rates, and with the whole kind of equity bond fund flows shifting over the past year plus, it's been a great product to bring people who traditionally had really transacted in the fixed income space into the equity market space, and that's actually been a great trend. So I think innovation and new product design that actually tries to target types of clients that we maybe historically haven't seen in the marketplace as much is actually that's been a great success.
So Liz, one of the things that you mentioned, seeing new clients use weekly, I'd like to ask the panel if you see other new trends evolving in the use of listed options that are bringing new entrants into the market and really looking to grow that pie, which is really so important to everyone's business here. Do you want to start, Francine?
Sure. A couple things I think about. I think DMA for our institutional investors probably going to grow further, especially if we have more sophisticated, right, as retail institutional. I just think anything electronic algos, hopefully, except now you're seeing now, I'm just speculating, like to me, that's the next frontier. I'm glad that on the option side, everything had to go on exchanges. The more we can provide ways for things to trade easily, it will help. And I really think by educating and getting more and more options traders involved, I think we'll get there. I think algos are probably not where they need to be. I think DMA is probably not as proliferated as they should be. And I think that's going to be interesting.
Just to kind of touch upon that, I think it's the products that we talked about. I think clients are looking for products. I think clients are looking for efficient ways to trade, right? Be it algos or DMA or other forms of access. Customization becomes big when you're looking to achieve what their end trading goal is. So I think those are areas where we'll probably see more demand, more growth. Aside from that, in terms of new entrants, I think we're seeing a younger generation enter into this space, and alternatives are options are a very attractive way for people to hedge and to manage their risk, and hopefully we'll see more women in this space.
Jessica?
On that point, I was on the trading floor last week, and in the SPX market, there was about like 4 women, maybe like 70 men. And, but then with our clients, the electronic traders, it's about 40 to 60. So I do think that there will be more women coming in with more of the technology, like depending on technology. I also think just on the note about like new firms coming into the industry, and this is more on the outskirts, but I have noticed a lot of technology providers as like analytics tools and like cloud technology and stuff like that coming into the market and advertising at the different conferences. So I'm seeing a lot more technology vendors just from the analytical side and stuff like that coming in as well. So.
Terrific, and I think we have a couple minutes left. Why don't we see if we have any questions from the audience?
I really like the question about the benefit to the end user of more exchanges, and I agree that the innovations like weeklies and pretty much just weeklies is good, but from here, what is the benefit to the end user of more exchanges in your mind?
I think, I'm going to just, my opinion, I think the market's going to determine what's the optimal number of exchanges. I think as it does serve now as a barrier to entry, as to operate robustly, efficiently, and profitably as a business. That would be the guiding principle. So to me, whether that number is 12 or 20, I don't know, but it has to be a reason. So I think Liz kind of already hit it on the head. So unless it provides something new and innovative and a service to someone, it's naturally going to stop. So to me, I understand the frustration, I understand the technology challenges, but wow, it's so much less than equities. And I also want to use this opportunity to go, we have focused on equities and options. I think it's the most regulated and transparent of all the listed or tradable instruments. Maybe the SEC should focus on outside of options and equities. There's certainly commodities and fixed income that are wild, wild west, in my opinion.
Any other questions from the audience?
Not that I really need a microphone. I'm trying to do Tony from before. No, but I look at it, personally. I look at the industry, and I look at it beyond options, but I look at the industry from the options place. That I've been telling people for years that the effective use of options to benefit a portfolio and increase yield, and I do that. And my wife, who's behind me, does it to her girlfriends and the people that really manage the money in the family, and they listen to her more than they'll ever listen to me. Well, there's 5 of you, and you represent a tremendous industry. How can we have your voices heard so they are heard, and to other women that manage the wealth of the family in many cases?
Well, opportunities like this are always great, and we do really appreciate the stage. I also think, it was brought up in the Exchange Leaders panel, but as we're trying to attract new sort of clients into the industry, education is a big part of it. And actually collaborating, we sit in different types of functions across the industry, but really collaborating with the exchanges and OIC, but also actually the people who, day-to-day interact with clients is really important. And I think that's a place where, we day-to-day talk to clients, get their mind share, and we make decisions about how to actually use that mind share. Like, what are you going to actually talk to them about? So actually that collaboration, I think, is critically important. And, as you said before, there are a lot more women actually in the places where we sit than, in some of those.
Is it something that Wild promotes?
Well, we promote the advancement of women in the industry. So we promote, we try to, I think that women don't have as much confidence as men do. And that's just being a general observation. And sorry. And some women are very confident, some women aren't. But I think that men are just a little more confident. And I think Wild tries to kind of build women up a little more and give them the confidence and the tools they need to be heard. So I think that's something that Wild definitely addresses. And we address that with our workshops, with our networking events, just kind of bringing awareness and education that women do have different challenges than men, and just recognizing that. And then, really quick, Liz told a great story at lunch yesterday about, in an interview, someone asked a woman if she had quant skills, and she said no. And then Liz was like, did you ask any quant skills? And I think it's really important because, we bring a lot to the table. It's just different from men. And I think that just kind of knowing that there is a difference and recognizing that there's a difference and recognizing that women need have different needs in career development than men do is really important for not only Wild, but male decision makers as well. So if you are managing women, it's important to realize that they might not be asking for the help they need. They might not be talking about the stuff that they know. And so you have to address conversations differently with them, and maybe just know that they have different challenges. And that's the first step, is just recognizing that they have different challenges, because once you recognize that, then you can address them in different ways, build them up, and then their voice will be heard.
Barry, if I can address just the point of women in the industry, how to encourage more. The one thing I found is that regardless of the number of women in the options industry, the options industry has been very welcoming to all of us, right? And that's encouraging in and of itself. I think part of it's on us. It's part of it's on us as women to encourage other women to get into this space. And I think it's the combination of all of that where we might see a little bit of change going forward.
That's, to me, is like another great business idea. If I was in a position to kind of put seminars and teach women who are managing family money to learn how to trade options, I'm like, wow, that could be a cool career. I don't know, something about it. Just like state pensions, like those are great things to go after. I think it's fantastic to hear this kind of, and have triggers in my head go, wow, what a market to tap into.
Terrific. Well, I think we're out of time, so thank you all so much. This has really been a nice opportunity for us. Thank you.
Thank you. Did I do one?
I took a sip.
So, yeah, and I hate to cut it short. I apologize when there's still more questions out there, but thank you guys very much.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.